Michael Burry just issued his final warning, and he's betting against real estate. The man who predicted the 2008 housing crash is now shorting home builders, REITs, and mortgage securities. Home sales collapsed to 3.8 million, the lowest since 2010. Inventory is building, up 25% year over year. We're 60 days from spring selling season. If inventory floods the market and buyers don't show up, prices will break. Burry sees 2008 all over again, and he's positioning for a 30% to 40% collapse. Michael Burry doesn't issue warnings lightly. He called the subprime mortgage crisis when everyone said housing only goes up. Now he's warning again, and his hedge fund is loaded with short positions against real estate. In the next 13 minutes, I'll show you exactly why Burry thinks real estate is about to collapse and what you need to do in the next 60 days. Hit subscribe and turn on notifications. Tomorrow, I'm releasing Where to Buy Real Estate After the Crash. Let's go. Here's what's happening. The Federal Reserve raised interest rates from near zero in 2021 to over 5% by 2023 to fight inflation. Mortgage rates, which were 3% in 2021, spiked to 8% in late 2023 and are currently around 7.2% for a 30-year fixed mortgage as of January 2026. This has destroyed affordability. A buyer purchasing a median-priced home at $420,000 with 20% down and a 7.2% mortgage rate faces a monthly payment of approximately $2,150, not including property taxes, insurance, and maintenance. For a household earning the median income of $75,000, that payment represents 38% of gross income, well above the traditional 28% affordability threshold. The result is a demand collapse. Existing home sales have fallen to an annualized rate of approximately 3.8 million units as of late 2025, the lowest level since 2010 during the aftermath of the financial crisis. Mortgage applications are down roughly 35% year over year. Refinance activity is near decade lows because most homeowners locked in 3% to 4% rates during the pandemic and refused to move. At the same time, inventory is building. Active listings are up approximately 25% year over year in late 2025. Months of supply, the time it would take to sell all available homes at the current sales pace, has climbed to around 4.2 months. A balanced market is typically 5 to 6 months of supply. Anything above 6 months is a buyer's market where prices fall. We're approaching that threshold rapidly. Spring selling season, which kicks off in March, is historically when inventory floods the market as sellers list homes to capture peak buyer demand. But this year, buyer demand is collapsing while inventory is building. If sellers panic and flood the market in March and April, and buyers remain sidelined due to high rates and unaffordable prices, we'll see forced price cuts, capitulation, and a cascading decline. Michael Burry's hedge fund, Scion Asset Management, has been positioning for this. According to 13F filings from Q3 2025, Scion held short positions and put options against major home builders, real estate investment trusts, and mortgage-backed securities. Burry is betting that real estate crashes within the next 12 months. He did this in 2005 and 2006 before the subprime collapse. He's doing it again now. Here's the unfair part. Retail home buyers are being told by real estate agents, mortgage brokers, and the media that now is a great time to buy because inventory is low and rates might go higher. Buy now or be priced out forever, the same mantra from 2005 and 2006. Meanwhile, institutional investors like Blackstone and private equity firms have been quietly selling single-family rental portfolios and reducing exposure to residential real estate throughout 2024 and 2025. Michael Burry and other hedge fund managers are shorting the sector while retail buyers are being pushed to buy at the peak. First-time home buyers, lured by fear of missing out, are signing mortgages at 7% rates on overpriced homes. When prices fall 20% to 30%, those buyers will be underwater, owing more than the home is worth and trapped. The smart money is exiting while retail is entering. This is wealth transfer by design. Let's break down the data. According to the National Association of Realtors, existing home sales fell to an annualized rate of approximately 3.8 million units in late 2025, down roughly 20% from 2024, and the lowest level since 2010. Mortgage rates, as tracked by Freddie Mac, averaged around 7.2% for a 30-year fixed-rate mortgage in early January 2026. This compares to an average of 3.1% in late 2021. At a 7.2% rate, a buyer purchasing a $420,000 home with a 20% down payment of $84,000 would borrow $336,000. The monthly principal and interest payment would be approximately $2,280. Adding property taxes at 1.2% annually, homeowners insurance at 0.5%, and maintenance costs brings the total monthly housing cost to roughly $2,150 or higher. With median household income at approximately $75,000 per year, or $6,250 per month gross. A $2,250 housing payment represents 45.6% of gross income, far above the 28% debt-to-income ratio traditionally considered affordable. Even using conservative assumptions, housing affordability is at the worst level in over 40 years. Inventory data from Realtor.com shows active listings increased approximately 25% year over year in Q4 2025. Months of supply climbed to around 4.2 months nationally, up from 3.0 months a year earlier. Regional data shows some markets like Austin, Phoenix, and Boise already exceeding 6 months of supply, signaling local buyers markets where prices are starting to fall. Mortgage application volume, tracked by the Mortgage Bankers Association, was down approximately 35% year over year in late 2025. Refinance applications are near decade lows because homeowners with existing mortgages at 3% to 4% have no incentive to refinance at 7% plus. Commercial real estate is also collapsing. Office vacancy rates nationally are around 20%, with major cities like San Francisco above 25%. Commercial real estate loan default rates climbed to approximately 5.8% in Q3 2025, up from 3.2% a year earlier. Regional banks with heavy CRE exposure are under stress. Scion Asset Management is 13F filings from Q3 2025 revealed put options and short positions against several major home builders and rates, signaling Burry's conviction that real estate is overvalued and poised to crash. Michael Burry became famous for predicting the 2008 housing crash. Between 2005 and 2007, he analyzed subprime mortgage data and concluded that housing was in a bubble fueled by reckless lending and unsustainable price appreciation. He bet against mortgage-backed securities through credit default swaps and made a fortune when the market collapsed in 2008. The pattern is repeating. In 2005, everyone said housing only goes up. Prices had risen for years. Affordability was stretched, but low teaser rates on adjustable rate mortgages kept demand alive. When rates reset higher, buyers disappeared, inventory spiked, and prices collapsed 30% to 40% nationally, and over 50% in markets like Las Vegas, Phoenix, and Miami. Today, we have similar dynamics. Prices up nearly 50% in 5 years, affordability at historic lows, demand collapsing, and inventory building. The difference is, we don't have subprime lending at the same scale, but we do have record household debt, student loans, credit card debt at all-time highs, and an economy teetering on recession. When layoffs accelerate and buyers can't afford payments, foreclosures will spike and forced selling will crash prices. Signal 1, watch the Case-Shiller Home Price Index for the first year-over-year decline. Case-Shiller is the gold standard for tracking home price trends. If it shows prices falling year over year, it confirms the trend has reversed and a cascading decline is underway. Signal 2, watch mortgage rates. If rates break above 8% and stay there, it will lock out the remaining pool of buyers and force sellers to capitulate on price. An 8% mortgage rate would push monthly payments above $3,000 for a median home, completely unaffordable for most buyers. Signal 3, watch months of inventory supply. If it exceeds 6 months nationally, it signals an official buyer's market. Sellers will panic, price cuts will accelerate, the collapse will feed on itself. Signal 4, watch earnings from major home builders like Toll Brothers, D.R. Horton, and Lennar. If they report negative earnings, surprises, declining order volumes, or rising cancellations, it confirms that demand has collapsed and the housing market is breaking. The fundamentals are undeniable. Mortgage rates are at 7.2%. Home prices are at $420,000, up 48% since 2019. Monthly payments are $250 on median household income of $75,000. That's 38% to 45% of gross income. Home sales collapsed to $3.8 million, the lowest since 2010. Inventory is up 25% year over year. Months of supply is climbing towards 6 months. Affordability is the worst in history. At the same time, household debt is at record levels. Credit card debt exceeds $1 trillion. Student loan payments resumed in 2023 and are straining household budgets. Layoffs are accelerating in tech, finance, and real estate sectors. If unemployment rises and buyers lose jobs, foreclosures will spike. Real estate is overvalued, overleveraged, and heading for a crash. Risk 1, if you're buying real estate now, you're buying at the peak. Prices could fall 20% to 30% within 12 to 18 months. You'll be underwater and trapped. Risk 2, if you're holding investment properties with variable rate debt or maturing mortgages, refinancing at 7% plus rates will destroy cash flow. Forced selling will accelerate. Risk 3, home builder stocks, REITs, and mortgage securities are extremely risky. If Burry is right, these assets will crash 40% to 60%. Smart play? Wait. Sit in cash. Let the market correct. Buy real estate in 2027 or 2028 when prices have fallen 30% and desperate sellers flood the market. Real estate agents, mortgage brokers, And the National Association of Realtors will tell you that housing never crashes. Inventory is tight, and you need to buy now before rates go higher. This is psychological warfare designed to trap you at the peak. Michael Burry is shorting the sector. Institutional investors are selling. Trust the data and the smart money, not the sales pitch. Scenario 1, 50% probability. Controlled decline through 2026 and 2027. Prices fall 15% to 20%. Regional markets like Austin, Phoenix, and Boise fall 25% to 30%. Foreclosures rise modestly. This is the soft landing scenario. Scenario 2, 30% probability. Cascading collapse within 12 months. Prices fall 30% to 40% nationally. Unemployment spikes. Foreclosures surge. Forced selling accelerates. This is the 2008 replay. Scenario 3, 20% probability. Fed cuts rates aggressively in 2026. Mortgage rates fall to 5%. Demand stabilizes. Prices correct modestly by 5% to 10%. Collapse is delayed. Timeline, 60 days from now is early March 2026, spring selling season. If inventory floods the market and buyers don't show, prices break hard. Michael Burry is shorting real estate. Mortgage rates are 7.2%. Home prices are $420,000. Payments are $2,250 on $75,000 income. Sales collapsed to 3.8 million, inventory up 25%. We're 60 days from spring selling season. Watch for signals. Case-Shiller decline, rates above 8%, inventory above 6 months, home builder earnings miss. Don't buy now, wait for the crash. Subscribe for tomorrow's Where to Buy Real Estate After the Crash. Comment, are you buying, selling, or waiting? Let's go.